Jared Bibler, Iceland's Secret, the Untold Story of the World's Biggest Con. Dive into the astonishing account of Iceland's 2008 financial meltdown with Iceland's Secret, the Untold Story of the World's Biggest Con by Jared Bibler. Uncover the unique circumstances and murky dealings that led to the collapse of Iceland's three largest private banks, and discover the repercussions that sent shockwaves through the nation. The book dissects the cultural and historical roots that played a significant role in the crisis, as well as the shockingly flawed banking practices and deep-rooted corruption that contributed to this financial disaster. This summary will offer insights into the extent of the impact and the inadequate investigative processes that followed.
The 2008 Icelandic financial crisis. The collapse of Iceland's three largest banks in October 2008 was a devastating blow to the country's economy, wiping out the value of its stock market, causing massive unemployment and the disappearance of legally mandated pensions. The public's outrage led to the pots and pans revolution, demanding new elections and the resignations of politicians. Iceland's economy eventually recovered, but at a significant cost to its citizens, and its appeal to foreign tourists was due to the nosedive of its currency's value. The Icelandic crisis of 2008 was an earthquake that leveled the financial fortunes of a whole country. Iceland's economic turmoil. Iceland's economic collapse in 2008 was uniquely Icelandic and not only caused by the U.S. subprime crisis or Lehman Brothers collapse. The country's late development of an economic system due to being under Danish rule for so long, a trust in authority resulting in illegal orders being followed, and a small population where personal connections overrule accountability contributed to the crisis. Icelandic banks' mismanagement and inability to compete with international banks caused the widespread collapse of the economy. Overcoming obstacles in investigating banking crisis. The Icelandic authorities' investigation into the 2008 financial crisis was hindered by various obstacles, including lack of urgency, limited cooperation from banks, bureaucracy, and incompetence. The Financial Supervisory Authority, (FSA), struggled with miscommunication, leaks, and prior mistakes. Despite uncovering unusual buying activity prior to the crisis, the FME faced a culture that avoided conflict and naming names. However, the special prosecutor appointed by the Icelandic authorities asserted that people commit crimes, not banks. The investigation ultimately had to overcome these obstacles to have a chance at revealing the truth behind the banking crisis. The Icelandic Bank's Proprietary Trading Scheme. The Icelandic banks in the 1990s developed proprietary trading desks that bought their own bank's shares. This manipulation boosted demand for the stock, leading to increased prices. The banks did not publicly declare these purchases and instead bought huge blocks of shares from the prop desk near the end of each quarter. It was a typical buyback scheme but demanded no public disclosure. The banks persisted in this activity, considering it normal business practices, despite warnings from outsiders of the potential problems that could arise. Iceland bankers' fraudulent actions. Icelandic bankers used illegal tactics to manipulate their own bank's shares, leading to the corruption of the entire Icelandic economy. Wealthy private clients with discretionary mandates allowed banks to manage their money without permission for each transaction and created offshore shell companies to lend money and buy more bank shares. As no foreign banks or mutual fund companies purchased these shares, fictive trades were made illegally to fuel growth, earn commissions, and pay high salaries to bank executives. Copying manipulated the credit default swap (CDS) market, using depositors' money to sell insurance on itself. These corrupt tactics led Iceland's banking system to collapse in 2008. The coupling of fraudulent activities and the inflation-linked loan system. The Icelandic banks engaged in fraudulent activities, entered the mortgage market despite the government's lower rates, and fueled a speculative development bubble. These actions compounded inflation, which was baked into the entire economy as a result of the inflation-linked loan system. Traders utilized a move called a carry trade to borrow funds at a low interest rate, which boosted the demand for the Icelandic currency and further pushed up prices until the 2008 crash. Foreign liquidity in Iceland also inflated the value of Icelandic real estate and stocks, which funneled money into investment companies developing properties in Eastern Europe, but these investments often failed. News reports underestimate the significance of the bank failures by global standards. Iceland's economic collapse. In 2006, concerns about Iceland's economy were raised due to the country's high borrowing levels. Reports showed that Icelandic banks were growing by borrowing from larger European banks, which highlighted a dependency that could lead to eventual failure. Merrill Lynch, Danske Bank, and Fitch all reported on the concerning state of Iceland's economy. Despite these warnings, the country did not take corrective measures. The collapse of Iceland's banks, which represented 2/3 of the country's stock market value, had a catastrophic impact on the economy. Iceland's response to financial crimes. Iceland made significant efforts to bring criminal bankers to justice after the 2008 financial crash. The Special Parliamentary Commission report attributed the crisis to the unchecked growth of banks, easy access to foreign capital, and failed regulatory supervision. However, due to a lack of resources, political interest, and bureaucratic reshuffling, the Financial Supervisory Authority, FME, only investigated under 10% of the total financial crime cases. Consequently, the country prosecuted fewer low-ranking bank employees than high-profile executives. While the FME referred 80 cases of corporate malfeasance to the Special Prosecutor's Office, which resulted in 24 criminal cases between 2010 and 2017, the punishments meted out were limited. Iceland's law does not charge multiple crimes and limits sentences to a few years. The convicted were able to reduce their punishments to mere slaps on the wrist through appeals processes and tactics that kept their assets in foreign accounts untouched. Nevertheless, Iceland joined the International Organization of Securities Commissions, an essential regulatory organization, and brought more criminal fraud cases than the United States and the United Kingdom. The article closes with the author's question, was it enough? Have the lessons been properly learned? By no means. The FME did not investigate many cases, including accounting fraud, insider trading, and CDS market manipulation due to a lack of resources and political interest. Additionally, it did not fully examine the roles of some entities, such as Iceland's stock exchange and central bank. The need for effective financial regulation. Financial regulators must be independent, well-funded, and equipped with proper mechanisms to enforce their regulations. The lack of incentives to pursue regulation has resulted in a playing field where no one wants to be the only one to play fair. This issue is not unique to Iceland, and citizens of every nation should elect officials dedicated to fighting corporate crime, support an independent media, and demand accountability of their financial regulators. Additionally, regulators should have their compensation tied to the size and quality of the cases they bring, and economists should abandon the notion that markets are always rational and fair.
Iceland's financial crisis was a turning point in modern economic history, exposing the corrupt practices of the nation's banking sector and shedding light on the need for robust regulatory mechanisms. Iceland's Secret, the untold story of the world's biggest con, critically assesses the fiscal mismanagement, unchecked growth, and lack of regulatory enforcement that culminated in the fall of the Icelandic banks. While there were some isolated efforts to hold those responsible for the crisis accountable, the investigation overall failed to uncover systemic issues or address the underlying problems. The lessons from the Icelandic crisis emphasize the importance of proper governance and the need for an active, unbiased media to better protect citizens and economies across the globe.